it is surprisingly hard to hear a message that amounts to, don't worry, be happy, and to find yourself not worrying and being happy. But we're going to try today.
We think we're in the middle of not just a price momentum market like so many people think. We are in the middle of an earnings momentum market where we are seeing strong growth coming in. And so everybody who's worried about, this wall of worry that we're climbing for the AI bubble, when you actually see the real numbers, the earnings are even stronger than you realize they are.
That's Rob Spivey, Director of Research at Valens Research. And in the market call today, he is talking about how he does believe that the rally has room to keep going because earnings are real. And his methodology digs into the accounting, and he says the numbers back up his assertions about how there's room to roll. But up first, Todd Rosenbluth, head of research at Vetify, brings us his ETF of the week, and it is a brand new ETF from the biggest of all fund companies that might be worth a look depending on your global outlook. Plus, we've got Dan Dorval, financial advisor at Dorval and Chorney, author of Financial Success for the Rest of Us, Quality of Life Planning for Mainstream America. The second edition of the book just came out, but Dan's always been a guy who I've turned to when I'm trying to get the pulse of how ordinary folks feel about their finances. And he believes that there's still plenty of room for ordinary Americans to experience financial success.
We're back to happy days again.
Well, yeah. Although it's been happy as the market's gotten to record highs, it stepped away from record highs, but there's plenty to be happy about. There's just concerns about how long it can last, and that's climbing the wall of worry, which the market does very well, and you should be doing too, right? Even though we just had yesterday from Cheryl Smith at Trillium a pretty sour take on what could happen, she still said you want to be dancing while the music's playing, and it's playing for now. I'm Chuck Jaffe, financial journalist and your host here on Money Life, and this is Money Life for October the 9th. We have a great show planned and executed for you today. We will have some copies of Dan Dorval's book. We'll give them away in a contest we're going to hold next week. This week, just too many moving parts because tomorrow I'm off to New York City for Advancing Business Editing and Writing Personal Finance Summit. I organized the first one of those. They just called it the Conference on Personal Finance when it was held in Boston 30 years ago this month. And that is the event that I believe included the most influential speech I have ever witnessed, certainly one I've talked about more than any other speech. And the keynote speaker who I had arranged because I was organizing the conference was supposed to be Jack Bogle. And Jack had to bail out on us at the last minute because he was getting a heart transplant. So there came a point about 2 weeks, 10 days, 2 weeks before the event where Jack said, I've been told I'm not allowed to travel because I'm so high on the list, et cetera. I have to be here. So Jack bails out, and we got a guy named Bill Berger. And if you're old enough, you might remember Bill Berger and the Berger Funds. But Bill Berger came and gave a speech in which he forecast Dow 116,200. And I can tell you, because I will be writing about that speech again this month, that if you put that in a headline, everybody goes crazy. And they talk about, oh, well, this is proof that the market's getting frothy. Because right now the Dow is at 46,601. But here's the thing. While it took years after James Glassman and Kevin Hassett wrote Dow 36,000 for the Dow to get to 36,000, here's the thing. Bill Berger predicted Dow 116,200 in 1995, and he said it would take 45 years for it to happen. That means 2040. And the reason he did that was that to go from where the market was in October of 1995, which was in the 4,000 range, to 116,200 would be the exact same growth he had seen in the first 45 years of his investment career, where the Dow had gone from a couple of hundred up to 4,500. So he was basically saying history would repeat itself. And while you put that number out there and it doesn't seem real, and 2040 is now only 15 years away, well, he's 2/3 of the way through, and he only needs about 6%. Like 6% annualized for the next 15 years? Yeah, spot on. Greatest forecast I've ever heard. So I'll be thinking about that. I'll actually be talking about that a little bit because I am one of the presenters at the conference tomorrow. So that's part of what's going on. But I love telling stories like that. If you like hearing them, you want to encourage me to tell more, you want to encourage me to get certain guests, or just you got a question or anything else, Chuck at moneylifeshow.com. I would love to hear from you. But right now, I'm betting you want to hear from our guests, so that's what we're going to do. Again, Todd Rosenbluth, Dan Dorval, and then Rob Spivey of Valens Research in the Market Call. We'll kick things off with the ETF of the week when the talk starts right after this message.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
One fund on point for today, the expert to talk about it. This is the ETF of the week. Yes, welcome to the ETF of the week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with Todd Rosenbluth, the head of research at Vetify. And if you go to vetify.com, you will find all the tools and research you need to become a savvier, smarter investor in exchange-traded funds. Todd Rosenbluth, great to chat with you again.
Great to be back, Chuck.
Your ETF of the week is
The Vanguard Emerging Markets ex-China ETF, VEXC.
VEXC, the Vanguard Emerging Markets ex-China ETF. Now, this, we talk about new and newsworthy. Well, this is new. It's the ETF of the week because it's like been around for like a week at this point. Why this fund right out of the box?
That's right. This fund launched at the end of September, excluding China from a portfolio or from an ETF to make it easier within a portfolio is not a new concept. iShares has been a leader within that space. What's new and newsworthy or exciting to me about this is a couple-fold. One, the Vanguard Emerging Markets ETF, VWO, is a $100 billion ETF. This ETF, this new one from Vanguard, VEXC, pairs very nicely. I'm sure we'll talk about how in a moment. VEXC is just 7 basis points, so it's extremely cheap. And Vanguard, I mean, they don't launch that many ETFs, and what they've been launching as of late have been actively managed fixed income ETFs. So for Vanguard, who is known primarily being an index-based provider, bringing something new out of the gate, that caught my eye.
And I understand why, but let's talk briefly about portfolio construction and how this one is managed, because you mentioned the VWO. That's the Vanguard FTSE Emerging Markets ETF. Is this fund basically that fund, just take out everything based in China? Is this that exact same methodology minus exactly what you think it would be excluded?
Yes, it's as simple as that. So China represents roughly a third of the assets that are in VWO. It's by far the largest country. And then Taiwan and India are other countries that are represented within the broader emerging markets ETF, VWO. So what VEXC does is excludes all of those Chinese stocks. And so the weighting in Taiwanese and Indian stocks, South African stocks, I could name additional markets as well. We'd be here a while. You see much more weighting there. So if you are concerned about the role China is playing within your portfolio, or you're concerned about the US-China relations, to me, there's a couple of things you could do with this ETF. One is it could be an outright replacement for VWO. You might not have fully appreciated that you had so much exposure to China and you don't want any exposure to China. Then VEXC is a way of doing that. What we found with the ex-China ETFs, in particular the iShares product, is that it's being used to pair with that broader emerging markets one. So instead of having 35 or 33% exposure to China, what if you wanted to bring that down to 20%, for example? You can't remove the China from your ETF that already holds China, but you can add an ex-China ETF into that. And so you then are narrowing the exposure that you'd have to China by using some of your international equity exposure to buy VEXC.
Todd, you and I have known each other for a long time, and I read a lot of things. And I am never surprised when I'm reading something about the ETF space and I'm like, oh, there's Todd. Well, I remember a story, I think it was an Investor's Business Daily, that was from this past summer, where you were talking about how emerging markets ex-China funds were falling out of favor, largely because they hadn't performed as well, so that they'd been very popular a year or two ago, and they were less popular now. So that's all these funds on the whole. Then we've got this new issue. How do you resolve that too? Or did I misquote you there? Because I very distinctly remember a story where it's like, oh, I wonder when this will show up on ETF for the week. And here it is now, a few months later.
Here it is. Now, obviously, I stand by that. The facts are the fact. Money has been flowing out of the ex-China ETFs this year. In particular, the iShares product has seen net outflows because China has performed relatively well. I think if you looked at an ex-China ETF and a inclusive of China ETF, they're close in a performance this year. I think the inclusive of China ETF is outperforming by 100 or so basis points the last time that I looked when I was thinking about talking about VXC. So it hasn't been as rewarding and investors have not been favoring it as much. Now, should they? Again, I'm not here to give investment advice. I'm highlighting the fact that Vanguard, who many people are using to get emerging markets exposure, has brought something to the market that allows you to better control that. And it's considerably cheaper. So do you think China is going to outperform the broader emerging markets between now and the rest of the year or into 2026? If you do, VEXC is not the fund for you. If you think China is going to underperform and you still want to have exposure to other emerging markets, either paired with your VWO product or another product, or you want to do it as a standalone, VXC makes a lot of sense to me.
Speaking of making sense, one of the things that you have talked about a lot with a lot of the recent picks for ETF of the week has been active management, how you like active management. Now, this, again, not an actively managed fund. But since you're talking about pairing strategies, is this a case where if somebody has their favorite emerging markets fund, they're investing in Seafarer or something along those lines with an active manager, or they're doing it with one of the ETFs we've discussed in the space previously, do you want to pair this with an active manager, not just the China component, but also get your active and passive in emerging markets that way? And conversely, if you're looking at an ex-China fund and you already are indexed, do you lose some of the appeal because both of these funds would be passive?
If you are using an active manager to get exposure to emerging markets, then you're deferring to that management team to make a top-down call on where the exposure is. I was going to say top-down call, but many of these funds are doing bottom-up selection, but they might not have a lot of exposure to China. They might not find the appeal. So that's partially being done for you. So can this complement an active strategy and offer you a cheap index-based approach? Yes. You just are reducing your exposure to China. So if that active manager is doing it for you, you might just feel more comfortable letting somebody do that. I think this goes well for somebody who wants emerging markets exposure and has concerns about having too much towards China. Whether they want to have nothing towards China, that may make sense. You're obviously taking a significant risk of underperformance because the Chinese stock market can do well. It has historically done well, not every year, but it has historically done well enough that you might want to have representation. But this is a cheap, broad market approach that just makes it easier for you to reduce exposure to China from Vanguard. So there's a lot of things to consider on this fund.
Do you have a sense in your own mind about if anything changes if we get into or avoid trade wars with China? Like, is this fund going to be particularly tariff sensitive? Is there anything else that is a factor here beyond that it's new and it's covering this space in this way?
I would have thought, and I think many people might have thought, that the Chinese stock market would not perform well, given that the U.S.-China relations under the Trump administration have not been very smooth, and yet the Chinese stock market has done quite well, and emerging markets have done quite well. So I'm not sure my tea leaf reading is going to be as strong as it should be. But if you are concerned about your exposure to China, this is a good way of doing that in a low cost, broadly diversified manner. I probably sound like a broken record, but this is a relatively simple fund. And so my comments are often going to be straightforward.
Yep. Banging the drum hard on the elements that make this fund attractive. That's exactly what you should do, because you've made VEXC, the Vanguard Emerging Markets ex-China ETF, the ETF of the week for this week, for its in its second week in existence. Todd, great stuff. Always is. Thanks so much for joining me. We'll talk to you again next week.
Sounds great, Chuck.
Todd Rosenbluth is head of research at Vetify. Go to vetify.com for more information to check out this fund or any of your funds in terms of the research they've got available there. And of course, Todd starts us off every Thursday on Money Life, and we are just getting started. Later, the market call will feature Rob Spivey, director of research at Valens Research. But up next, the book interview with Dan Dorval, talking about financial planning for the rest of us. That's coming when we come back in a moment.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Did you know that there are at least 23 million American adults who can't read a want-ad?
It's called reading. Top to bottom, left to right. Group words together as a sentence.
Money Life presents.
I'm chatting with my guest, author, lecturer.
You get him to open his mind and his future.
The book interview.
Give a kid a book and you'll give a kid a break.
That's gonna be radical, Chuck.
Reading is good. Can we start the story now?
We sure can. And this story really applies, well, I hope to all of you, because my guest is Dan Dorval. He is the author of Financial Success for the Rest of Us, Quality of Life Planning for Mainstream America. And he's the author of that book now in its second edition, but it's taken him 25 years to do the second edition. In that time, however, well, it's not that much has changed necessarily about financial planning, at least at Dan's end, although we have ETFs and other things that we didn't have 25 years ago. It's that while I was writing a weekly column, Dan Dorval was the guy who I would turn to when I wanted the financial advisor for the rest of us, if you will. You can work with planners at any given level, but he was not somebody who was saying, hey, let me make sure I've got the $1 million minimum or what have you. As he became more successful, he just worked harder with the people he had. And I always felt he was the proxy for school teachers and nurses and whatever when I wanted to talk to him. So when he wrote his first book, which was Financial Success for the Rest of Us, it was a great read. It was one of these things that you go, this, if you're not the person who thinks I'm going to be a gazillionaire and I want to add gazillions to it, this was a great book. And I'm really excited that he did it again. Now, if you want to learn more about Dan and the book, Dorval Chorney, because he is a partner at Dorval and Chorney, Dorval Chorney, CHORNE.com. And I should let everybody know, we've got a couple of signed copies. We'll be giving them away in a contest as well. So you can try to enter that to win a copy of Financial Success for the Rest of Us. Dan Dorval, it's great to chat with you again. Welcome back to Money Life. I don't think you've been on the show for over a decade at this point, but it's great to have you back.
Yeah, appreciate it, Chuck.
I want to talk about what I first noticed about the new book, which is quality of life planning. And if people could see me as I'm doing this, I'm making air quotes around quality of life, because most people talk about financial planning and they don't think about it as quality of life planning. And is that how the rest of us should be looking at it? Like, let's not look at this entirely on the financial side. Let's look at this first on the quality of life side.
Well, that's one of the biggest changes from the first edition of the book to the second edition is I, with experience of helping thousands of people over the years, realized that it isn't the financial side that drives this. It's really what are your values and priorities and motivations that align with your quality of life. And that's different for everybody. And so financial planning is really putting together different puzzle pieces in order to create that quality of life that's important to you. And that really was a transition from 20 plus years ago.
But how did you come to that transition? Because one of the things that you and I had always talked about was, yes, you were my proxy for school teachers and nurses and ordinary people. And ordinary people, it's always the struggle to make the numbers. So was it that they weren't making the numbers? So, hey, let's not talk about the numbers. Let's talk about quality of life. Or was it the other way that, like, look, you don't need to make the numbers?
So when we talk about all of this, it's like a bunch of puzzle pieces, right? And what most people do is those puzzle pieces, they focus on each piece at a time. And then they get super confused. So one piece might be investments, one piece might be social security, one piece might be health insurance, and they focus on each thing. And then they get caught up in that thing. And because they don't know for sure what they want to do, now they procrastinate, and maybe they have some really strong quality of life goals. Maybe they want to retire earlier, maybe they want to spend time with their grandkids, whatever that happens to be, but they get caught up in all the puzzle pieces. So they end up not moving forward with the things that are actually important to them. So we try to get them to move away from that focus on each individual piece and allow us to do our job, which is to put all those pieces together to create the picture of what's actually important for them. So these people had the numbers. In many cases, I have people come to me, they have plenty to do what they want to do. They don't know how to do it. And so they get caught up in the numbers, or they get caught up in the minutia of, the complexity of life. And all of a sudden, they're not moving forward with the things that actually matter to them. So we try to get them to step back, look at the big picture of what's really driving, what's really important to them, which shifts and evolves over life. And now we can get them to make decisions that are more in alignment with what matters.
From that perspective, how much, because you are working with those average folks, do you have to convince people you're retired now and it's okay to spend money? Because they spend their entire lives or the bulk of their lives in the accumulation phase, worrying that they're not going to have enough. Then they stop making money and they really worry that they don't have enough, but they don't let themselves go spend. So how often do you find yourself going, it's okay, use what you've actually accumulated?
Well, it's one of the biggest shifts in mindset that a lot of people have is they save, they save, they save. They spend their entire career saving for retirement. And one of the things I have to tell these people all the time is, in retirement, you're no longer saving for retirement. You're retired. You're actually spending the money that you work so hard to save and accumulate. And that is like a revelation to them. I mean, it sounds like common sense to all of us, but at the same time, I had a meeting yesterday with a nurse who's in great financial shape, and she thinks she's completely behind, in part because she has a pension, and her pension's actually pretty sizable. Well, she doesn't think of her pension as being as impactful as it actually is. So she doesn't have millions of dollars saved for retirement, and she thinks she needs millions of dollars saved for retirement. And now we walk them through this entire, puzzle pieces process, and we show her you're in great financial shape. But the noise of the world has her convinced that she needs to save more and she needs to save more. And so it's a frustrating process sometimes. And usually it takes people a while to wrap their brain around the idea, hey, I'm not saving anymore. I'm actually spending what I work so hard to save.
Given where we are in this country right now, the hard economic data says everything's good. And the soft economic data says, oh my God, consumer confidence is terrible. Because you are in that middle spot where your client is probably closer to the middle of a K and a K-shaped economy than necessarily at the high end or the low end, because they've done the right things planning wise. How much do you think that a bigger problem is people's perceptions? In other words, do you think broadly that economically speaking, we're okay and things are, the way they've always been, but emotionally we're struggling?
Yeah, I think that's an important point because emotionally, I can tell you, I've done this a long time. We've been through lots of different elections, lots of different economic situations, the Great Recession, the tech bust, all of those different things. And this time, I would argue it's different. So after this election, and with all of the media coverage and all the different things that were put out there, we had people coming to us that have never talked politics before and said, I'm just really worried. I feel like we're in a period of chaos. these are not people who know anything about the economy, by the way. I mean, I work predominantly with nurses. They're not following the Federal Reserve. They don't know a lot about the stock market or things like that. They're just thinking in terms of, I don't feel like we're in a good place. And that is such a strong issue that we have actually had a couple of our clients move out of country. So when you start thinking about quality of life, they had just bought a dream home in Washington state and they decided to move out of country and give up their dream home. Now, you talk about an emotional standpoint. This is driving people to make decisions that may or may not be aligned with that quality of life that we're talking about. This is different.
I know we have a few audience members who are actually planning that when they retire, they will retire abroad because of a variety of different reasons, some of which it's a lifetime dream. And if that's your dream, again, if you're not giving up the dream home to go pursue the next dream, that might make sense. If you're giving up the dream home because you're scared out of the dream home, that means you had a planning problem, right?
Yeah, it's a big concern for people that they're just relentlessly bombarded with noise, right? And so as they hear the same narrative, and we can pick our bubble in today's world. You can hear the same message over and over and over again and never hear another message. So part of our job is to help these people like get out of that bubble and maybe get a different perspective. I would argue one of the greatest values a good advisor actually brings to the table is perspective and being able to give you this idea of, hey, maybe you have fears, maybe you have concerns or anxiety, but maybe there are ways that we can kind of reposition those thoughts in order for you to move forward in a productive way.
Yeah. As I have said, having written 2 books on choosing and working with financial advisors, emotional discipline is what you're paying for. It's not what you're going to the advisor thinking you need, but it is what you ultimately want and are paying for, the discipline to stick with it. Which brings me to an interesting side, because one of the things I really like about your book is that it is not rigid on the path that you have to follow. And I think that that is really important because there is no one right way. There is the way that works for you. How important is it? Because I should point out, look, folks, if you read the book and you want to get to the investment part, you're skipping 6 chapters to get there. Okay? So in the realm of what is important for you to know, yes, investments are up there. There's plenty of other chapters afterwards, but you're skipping like the first 5 chapters to get there. So how important is it for you in a world that wants to put everybody in a box? And the boxes aren't bad. It's just not always one size fits all. How important is it for you that everybody, like, is it more important that they do, quote unquote, the right thing, or is it more important that they do the thing that's right for them?
Well, that's another great question because that's exactly what the quality of life planning means is it's entirely based on what's important to you. It really doesn't matter what your friends, family, coworkers, social media, none of that stuff actually matters in our conversation. And yet people will come into us and say, "Hey, well, they say that I should be doing this or that." And I'm like, "Well, who are they and what do they know about you?" Because if they don't know anything about you, you're taking a different path. You have a different set of goals. And highlighting that, again, that goes back to perspective, highlighting that for their specific situation, it doesn't really matter what the last people I saw wanted out of life or what the next people I see want out of life. It only matters what you want. And that's not the way the world works right now, especially marketing. They want you to think like you're in a box.
Last question. I did notice that like the last chapter is about alternative investments, which also 25 years ago, when you did the first edition, not so much focus on alternative investments. For you, are alternatives the classic alternatives that they would have been 25 years ago, which means anything that's not stocks, bonds, or cash, which those days was mostly real estate? Or is this about, hey, if you want to have Bitcoin and crypto, I mean, you're working with average people. Where do you go on alternatives? Like, you cover them, but how comfortable are you and how much should they be a part of the average person's portfolio?
Well, that chapter is actually a little bit more investment alternatives, not alternative investments, because for the vast majority of the people that we're helping, something like crypto or precious metals or, whatever other types of alternatives that people might be into, private equity or things like most of the people I deal with can't have access to private equity anyway. So if we're talking about crypto, we do see people, they'll come in and they say, hey, I bought some Bitcoin or I bought some of, this other crypto. And I go, well, why do you have it? And inevitably, they almost never have an answer for why. And we just view investments as tools to help you accomplish goals. And so if the idea is, I'm going to buy this and the price is going to go up, well, what if the price doesn't go up? Or at least for a period of time, the price doesn't go up. And now all of a sudden, people are sitting there going, well, okay, should I sell? Should I buy? It becomes a random set of decisions. So for the vast majority of people, they don't need alternative investments, but yet that's where like a lot of the hype is. That's where the excitement is. People get caught up in that idea. And I will tell you that one of the biggest issues from the book is most of the financial planning we do really relates well to women. And a lot of times men will be attracted to that. I don't know if get rich quick is the right way to put it, but they'll be attracted to the idea like, I want to be doing something with investments that the average person isn't doing. And they find that very attractive. So the marketing associated with alternatives is primarily geared toward men.
Yeah. Well, men are part of the rest of us, and maybe they should be looking at how they can be achieving financial success. The book is Financial Success for the Rest of Us, Quality of Life Planning for Mainstream America. It is the second edition. The second edition is better, Dan. I will tell you, it took 25 years to do it, but you did improve on it. And it's out now from Dan Dorval. Dan, thank you so much for joining me on the show.
Thank you, Chuck.
Dan Dorval is a partner at Dorval and Chorney. You can learn more about the firm and the book at dorvalchorney, CHORNE.com. And we have copies that we'll be giving away in a contest, so make sure you stick around for that. We've got more to go on today's edition of Money Life. So financial success for the rest of us. How about financial success for the rest of the show? Just stick around. We'll try to do that.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Rob Spivey, Director of Research at Valens Research, is here. We're talking stocks. It's market call time. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. And returning to the show today, Rob Spivey, Director of Research at Valens Research, which is not your sort of standard approach. We'll get into what they do that's different, but I'm always trying to bring you different and intriguing research. This qualifies. And if you want to learn more, Valens-Research, Valens, V-A-L-E-N-S, Valens-Research.com. Rob Spivey, welcome back to Money Life.
Chuck, thanks as always. Great to see you and great to be on the show.
We always start with methodology. I need you to explain your take on it because Valens isn't everybody else's research.
Yeah, exactly. And I mean, the biggest thing about what we do here at Valens that is a bit different is we are really a tools-based approach that starts with uniform accounting and understanding that you can't make any investment decisions if you are on corporates and real investment without knowing what the real numbers are for a company. And the issue is you talk to a CFO, you talk to an analyst with their salt, they'll all tell you the numbers that you get off the financials, they're a compliance exercise. They aren't really showing you how profitable Apple is or how profitable NVIDIA is. And so what we do is we go through and we make over 130 different adjustments to get to what real cleaned up accounting profitability is, growth is, and valuations are to identify which companies really are mispriced and not. So then we can do all of the other fundamental research that we do, from analyzing earnings calls with our proprietary technology to analyzing corporate strategy and compensation, all these other things that really fall into place. But they all start with that cleaned up accounting analytics.
I want to get back to the actual methodology, but before I do, I have to ask, given what you say about the need for uniform accounting and how you want to get that information and how important it is for your data, there is talk, it's still in the just talk stage, of making it the company's could have to report less often, like not do quarterly reports. Would that create opportunities because it would mean that you've got some vagaries in the data and you don't get a regular thing? Or would it eliminate opportunities because you don't get as much information, so you can't weigh it as well?
Yeah, it's a great question. And so, first off, the idea of us going to a, say, it's 6 month, half year reporting cycle versus a 3 month reporting cycle is in and of itself a silly discussion, right? I'll talk about the why in terms of why it actually would not disrupt us and create opportunities for us in a moment. But when you think about it, the whole entire logic for why is, that'll help fix management teams' problems with short termism, right? And basically, you're chasing the quarterly earnings number and everything else. And the fact of the matter is, the reason why management teams have short termism and are always chasing the next quarter actually has nothing to do with the fact that you're reporting on a quarterly basis. It has to do with, right, Chuck, you may know this, the average CEO is around at a company for 2 to 2.5 years. And if you're around for 2 to 2.5 years and your compensation metrics, right, your bonus metrics are tied to those short term metrics, you're going to chase those short term metrics, whether or not you reported once a year or once every 6 months, or whether or not you actually went to real-time data and flashes every month. Like, you see with some companies that actually do a flash for how many homes sold or that home builders do everything. So the fact of the matter is the idea that that's actually a good thing is wild to me. But for us, the thing is the quarterly data that you get already is unaudited data. And it's already only partial disclosure in terms of financials. So most of our data, our most important data, and actually real corporate profitability has to come from the annuals anyways. So it doesn't really actually wouldn't disrupt us that much. But in our view, it would be trying to fix a problem by using a hammer because that's all you have, as opposed to really thinking about how we need to fix corporate alignment instead is the bigger issue.
Given what you say about uniform accounting, how much of your research is what might be described as forensic accounting? How much of this is going in and going, okay, let's take a look at, you're reporting this as a street number, or, this has been said as a whisper. Here's what we're getting if we're following GAAP or whatever.
Yeah, and I mean, so when you think about that, so one of the other tools that we have beyond our uniform accounting is what we call earnings call forensics. And this framework that we have, and I mean, some of this is built from everything that we've learned from everybody from ex-FBI and CIA to even ex-Israeli Mossad, in terms of technology and framework. That analysis that we do there is focused on analyzing earnings calls to identify where we're seeing deceptions from management or literal giddiness from management teams. And we get in that idea of getting into the weeds of whisper numbers and stuff like that. That is where we're seeing insights like that. For uniform accounting, I wouldn't call it so much forensic accounting, because not that we're trying to say, hey, you reported inventory of X this year or revenue of Y, and that revenue was actually because of the fact that you channel stuff over here. We're less worried about that, but we're more worried about the idea that if you look at Sanofi, which is a European pharmaceutical company, and you look at Pfizer, which is a US pharmaceutical company, well, Pfizer, they have to expense all of their research and development, right? The biggest expense that they have as a pharmaceutical company. Really important to understanding how good their performance is to understand how much they're investing in R&D and how productive it is. Sanofi has discretion each year in terms of how much of their R&D they expense because it's research versus how much they capitalize because it's development of new drugs. And so the problem is all of a sudden we have incomparability there. So you can't actually even decide, or let's say Novo Nordisk versus Eli Lilly is a better example. They make all the same drugs, right? For lack of a better explanation. You look at that, if we don't have that like for like comparison, then we are just losing the thread here. And you can't really decide, is Novo more profitable? Is Lilly more profitable? Does Novo actually have more earnings growth, or does Lilly? You can't do that if you're not looking at some one standard unified approach. And it gets even worse when you compare companies across industries, let alone companies in the same industry. And that's what we're doing.
Is the research pulling out anything specific because we are so earnings driven right now? I mean, this has been a market and economy where everything has been powered by earnings, and the earnings have stayed strong. So are we at any sort of spot where you are noticing certain trends because of earnings and maybe the quality of earnings? Like, is the earnings quality as good as a market at record highs would suggest earnings quality should be?
Yeah, and this is the thing that's actually what's really interesting, Chuck, is when you look at it, what we're actually seeing in a lot of places are even stronger earnings than the as reported metrics reflect, which is not something you'd probably expect me to say based on the fact that we're cleanup accounting and trying to see through the noise. The reality is Because so many of the companies that are, if you talk about just the AI boom that's going on right now, that's powering so much of this earnings growth, right? Centered around the Meg 7, but also centered around all of the companies that funnel out of the Meg 7. There's this narrative out there that, oh, you know what? AI isn't making anybody money. And part of the reason why is because of how because accountants are so conservative in how they have to report things, that you get these issues and this noise. Like, for instance, companies that are investing a massive amount of money in research and development. Look, if you're looking at US Steel and US Steel spent $1 billion building a new steel plant, guess what happens? Only 1/30th of that $1 billion that they spent shows up on their income statement this year. Because you basically say, oh, well, we're going to capitalize that and we're going to depreciate it over time. If, I don't know, Google or Bloom Energy or somebody spends $1 billion on research and development today, that is $1 billion hit on their income statement, which is an investment for the next 2, 3, 5, 10 years. And so what happens is you all get all of a sudden this people that start talking about this, well, none of these companies are making money. No, no, no. They actually have really strong earnings growth, but it's being masked by how great the investment they're making is and how actively they're investing in the company too. And it's dislocations like that that create these opportunities where we can pick out and say, actually, that company that you think is just a hype story in the AI boom is doing a phenomenal thing. And that's why we think we're in the middle of not just a price momentum market like so many people think. We are in the middle of an earnings momentum market where we are seeing strong growth coming in. And so everybody who's worried about, this wall of worry that we're climbing for the AI bubble, when you actually see the real numbers, the earnings are even stronger than you realize they are.
So what's a poster child for the methodology? What's an example of a stock that you guys are high on, that you're particularly high on because of what you see in the accounting that maybe other people are high on for different reasons?
Yeah, like a great example of this in terms of a company that's really in the center of the AI ecosystem is somebody like ASML. So ASML, right? They make equipment to make chips, right? Taiwan Semiconductor doesn't exist without ASML. They make some of the most complex equipment out there. Well, the interesting thing that jumps out for us is we look at some things like, for instance, uniform return on assets. On an as reported basis, this company looks pretty good. It looks like it's got a 10 to 12% return on assets, which is basically saying all in, how much money do you make for every dollar you put into the business? But when we look at it from uniform accounting, what we see is this company's return on assets is pretty consistently around 20 to 25%. It's throwing off a lot more cash flow than people realize. And because of that, when you look at the company on a valuation basis on something like price to book, say it looks like it's trading at a really expensive valuation at 13, 14 times. When we look at it, we see it's also trading at a lower valuation. And so you look at this company that as we're going to need way more chips out there in the world, and the highest tech chips also, which are the chips you have to use their equipment to be able to make, they're going to make a lot more money and they're already more profitable than the market thinks. And so super, super interesting there. And just another example of this is, GE Vernova. GE Vernova, right? Ticker GEV, spun out of GE, a year or two ago. This business, when you look at it, what's so wild is on an as reported basis, it looks like they're barely making any money. That are 1% return on assets. What we can see, which is really interesting, is return on assets actually has improved each of the last 3 years, and it's at 6% now. But what's really excites us about GE Vernova, and for those of you who don't know, GE Vernova, if we're going to have a lot more power plants to be able to power all this AI, a lot of it's going to be natural gas power plants. They make the turbines you need for natural gas power plants. We can actually look at GE Vernova's return on assets of 6%, which is incredibly noisy because of the spinoff with GE. And we can see where return on assets can be in the future because we can genuinely compare them to a Siemens, to a Mitsubishi Heavy, to a Eaton that are out there. And we can see return on assets for this business are likely to get up to 15 to 20%, which the market is not pricing in yet because this AI boom. So it's names like that, Chuck, that we think are really, really interesting, that the uniform accounting helps us see a better window into just how profitable this business is.
And quickly, what makes you sell? And is there an example of something you moved away from? Is it all about the accounting, or is it, some other sort of fundamental change that just says whatever this company's done, it's time to take our profits or cut our losses?
Yeah, generally what we're paying attention to when we look to get out of something in terms of a thing that we're basically saying, hey, the bigger reason is not because a company has reached full valuation. Full valuation is a trigger to tell you start to pay attention. But as you know, Chuck, no company ever gets to full valuation, stops there. So instead, what we do, exactly your point, is we pay attention to two big things. We pay attention to when the market tells us something is going on and different for the company. And most importantly, we pay attention to when the fundamentals start to decelerate. So right, we're looking at things when we've got a growth company like a GE Vernova, we're looking for paying attention to when are we seeing that growth decelerate? Because when we can, on a uniform accounting basis, say uniform earnings is starting to crest, we know, okay, this is going to have multiple deflation. We should get out of this. We've got a company like ASML, what we're paying attention to, because it's less of a growth story. It's just a great fundamental business. We're saying, hey, do we see something changing in terms of the demand environment? We're paying attention to the fundamentals, but also we have a healthy respect that when the market breaks down for a company, when we see a pullback, something like 15, 20% from where we are, we'll step back and say, hold on, what's going on there too? We'll pay attention to those things because the uniform accounting opportunities tell us when something is compelling. But accounting alone, valuation does not tell you when to sell a stock. It just tells you when you stack the deck in your favor to buy a stock.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
I've got a good feeling about this.
And you should have a good feeling about what you are hearing from Rob Spivey, because the research is really interesting. He is director of that research at Valens Research, valens-research.com if you want to learn more about it. Quick and Dirty, of course, is our lightning round. It's where we put our guest to your test. If you want to test our guest for yourself, send your name, your hometown, and the ticker symbols you're interested in to Chuck at moneylifeshow.com. We'll add them to the list and hope they make it into an interview soon. We're going to start today with a request that has definitely been in the news this week. Tom in Smithfield, Kentucky wants to know about Fifth Third Bancorp. It's FITB, and it's been in the news because it's merging with Comerica.
That's exactly right. And you look at this. So this is a big surge that we expect to happen and continue to boom for the rest of the year. We think that we are about to be in a big M&A environment for the back half of this year, and banks are a big part of it in terms of consolidation. Fifth Third's acquisition of Comerica was just really, really smart, purely from a valuation basis. Before you even get to, whether or not they, from a geographic perspective, make sense, which they do, both basically a lot of footprint in the Midwest, but also Comerica with some Texas. When you look, the way that we think about companies, Chuck, is we think about companies in terms of embedded expectations. What's their real profitability today? What is the market pricing their profitability to be in the future? And so Fifth Third, the market is expecting Fifth Third to say return on assets is going to stay where it's been for a little while, around 12%. But Comerica, which they bought, Comerica's return on assets return on equity has been around, call it 11 to 13%. And the market was pricing return on equity for that business to fall to 9%. What that means is Fifth Third got a deal when they bought Comerica, and that benefits Fifth Third because that makes it way easier for them to make a lot more money than the investors are expecting. That's why we think Fifth Third is a buy after this Comerica acquisition.
Money in the bank.
And in this case, the bank is Fifth Third Bank, but also Comerica. So that's FITB and CMA. Tony in Henderson, Nevada wants to know about Leidos Holdings. It's LDOS.
Yeah, and Leidos, right? This was so funny for us. With the beginning of this year, everybody was having a panic about the idea that all of the defense contractors were going to be gutted, and that we were going to see, a multi-hundreds of billions of dollars cut out of the defense budget. And I mean, in fairness, that's what the government said. But of course, what happened literally less than, 2 months later, the government jacked up the budget for all the defense contractors. And Leidos is really interesting because Leidos benefits from being at the center of a lot of the things that are being invested in around AI and technical efficiency in the U.S. government, that they actually are one of the big consulting firms that helps that with that, along with doing a whole lot of other stuff for the Defense Department. And so because of that, Leidos has been a really profitable firm. Our return on assets, uniform accounting for them, around 40% a year. And the market is pricing it to fall to 25%. And so what that says to us is the market is overly pessimistic, thinking that the U.S. government is going to gut Leidos, not realizing the U.S. government is relying on Leidos. And for that reason, along with all the macro that we just talked about, we think that Leidos is a buy also.
So the market is looking at Leidos, LDOS, and thinking,
Either very smart or incredibly stupid.
but Rob Spivey, he's thinking,
could we please buy now?
That's a buy. Amy in San Diego wants to know about Elevance Health, ticker ELV.
Right. And Elevance Health, look, all of the HMOs are just, we have a big rule right now at Valens, which is when you talk about when you talk about healthcare and when you talk about the consumer, it's the trend is not your friend, and there is no bend in the trend anytime soon. Because the fact that in the healthcare world, you've got two big headwinds. Headwind one is reimbursement rates in general from the U.S. government to insurers like Elevance and everywhere else. And headwind two is what GLP-1s are doing to totally disrupt a lot of healthcare. Well, Elevance is not going to see any of the trends in terms of what the government pays it for the Medicare, Medicaid part of its business change anytime soon. And it continues to see cost squeezes everywhere else. So you look at this and this company might look cheap to you because the fact that you look at it and you go, well, it's trading only at an as reported PE of 11 times. On a uniform accounting basis, it's trading at a 15 times PE, which is actually pretty good for an HMO and around where it's traded historically. So it's not trading at cheap valuations, even with how much it's fallen recently. And for this reason, we would say stay away from this one. This one still could fall even further, even after how it's gotten beaten up so far this year.
Put that one on the psycho list.
Yeah. Or you're certainly not going to put it on the buy list. That was a seller and avoid on ELV, Elevance Health. Laura in San Antonio, Texas wants to know about Bloom Energy, BE.
Yeah, BE is an amazingly fascinating company. This company does, they basically make fuel cells, natural gas fuel cells, to be able to allow companies to power their whatever it is, if it's an AI data center, a fab, a factory, a hospital, without being on the grid as the grid becomes more taxed. This company, on an as reported basis, it looks like it barely turned profitable last year. On a uniform accounting basis, it has been profitable for the last 3 years. And it has just been profitable for the last 3 years. It is seeing its return on assets ramp pretty steadily because it is starting to scale, and it's got the capacity in its factories to be able to make 5x what it currently makes in terms of the number of fuel cells. And you are going to see a huge demand surge for this because so many of these AI data center companies are trying to figure out how to get power without getting politicians in trouble by taxing the grid and driving power prices up. And so that means Bloom has a way longer run rate than anybody realizes, even though the company is up 200, 300% in the last 3 months. It's got a lot more upside beyond that. And so this is one that we still think is compelling, even after the rip that it's seen. This is a buy.
I want all the power you can give me.
And in this case, the power is coming from Bloom Energy. BE could power your portfolio. That was a buy. And last, in the limited time we have left, for David in Missoula, Montana, it's Fanuc Corporation. That ADR trades under FANUY.
The really simple thing to know about Fanuc is if you think that we are going to have a robotics revolution in the United States, Fanuc is not priced for it, but they are one of the people who make a lot of the key equipment to be able to do it. So if we're going to bring more manufacturing back to the United States, we are going to need more of their robots, and the market is not pricing them for that surge. This company could look in profitability 2x like it is right now, and we think that's really compelling. That's why we think it's a buy.
And so we finish with a high note because Fanuc, FANUY,
buy it outright.
And yeah, it's always good to end on a high note, but all the notes have been great here. Rob, this has been really interesting. Thank you so much for coming back to the show. We're going to be talking with Joel Littman from Valens about your ETF research at the end of November. So we're looking forward to that too, but thank you for today.
Chuck, a pleasure as always. Thanks for having me on.
That's Rob Spivey, the Director of Research at Valens Research. Valens, V-A-L-E-N-S, valens-research.com for more information. And we'll be back. We'll tell you where Rob agreed or disagreed with some recent guests, and then we'll wrap up this edition of Money Life right after this message.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
We're back to put a bow on this show, but we've got a few things to do before we get there, right? I wanted to point out something from yesterday's show before I totally forget about it. We talked with Natalie Iannello yesterday, and there was that study in which 41% of the people felt that real estate would provide a better return than the stock market moving forward. And that's just not what real estate does historically. You have stretches where it does really well, but a house, for example, if you expect that your house is going to do better than the market is, historically, that has not been the way it works. It is stocks, bonds, and real estate, maybe gold are your sort of traditional non-alternative assets. And I just point that out because when you hear that and you're thinking, okay, now you know why people are unhappy that they cannot afford a home, and yet at the same time, they don't realize quite that a home is a use asset and less likely to be the cornerstone of your portfolio in terms of growth. Dan Dorval talked about the story with the nurse who feels she's behind when he says she's on solid ground. and she doesn't know that she's on solid ground in part because she has a pension. There are studies, we've talked about some of them in the last few days, that talk about how prepared or unprepared people feel they are for retirement. And this is a thing. It's kind of akin to what we're seeing with people saying, oh, the economy is terrible, but they're going out and spending like it's all fine. And you'd hope that it actually is fine in their house, which just means it's more terrible for somebody else. But yes, you hope that people are doing right by themselves and not kind of saying one thing and acting a different way and having it hurt their finances more. Rob Spivey, just a little bit of crossover with him, between him and recent guests. His first poster child, the first example he gave was ASML. Garvin J. Bush from Green Alpha was buying it on July the 11th, and Dryden Pence from Pence Wealth Management was buying it on July the 2nd. Then during Quick and Dirty, you had Elevance Health, ELV. It was a sell today. Jeff Oxshore from the Oxshore Focus Fund was buying it back on August the 26th. So there's your crossover. We've got big things planned on this show tomorrow, including the debut of David Lundgren from Little Harbor Advisors talking technicals. We're taping a couple of things because I will be away, so we're taping a few things today. So Meb Faber from Cambria will either be here tomorrow or Monday. It'll depend on when we want to run that interview and spread out the things that we've got, because we'd like to make it that we get you everything done for the next couple of days, and we'll figure out the order. But Meb will be here either tomorrow or Monday. Eddie Gabor from Key Wealth Advisors will be here on the other day when Meb is not. Plus, like I said, David Lundgren and a lot more. Meanwhile, if you're looking for something to celebrate, there's a few things today. It is Curious Events Day. It is Fire Prevention Day. It is National Depression Screening Day. And although some of these days are a joke, that one is not. And if you are worried about it, if you are feeling like things are off, please be checked out. It is National Sneakers Day. Then on the food front, it is National Moldy Cheese Day.
Blessed are the cheesemakers.
It is also Submarine Hoagie Hero Grinder Day. I tend to call them a sub, but I'll eat them any way you want. For me, it would be Submarine Hero Hoagie Grinder. That would be the way, because I've lived in places where it's all of those things. And any way you cut it, I hope you make me a big one and leave it for me. I'm down for subs. Absolutely. It's also, however, if you're not a sub person, it is International Beer and Pizza Day.
Pizza.
Yeah, well, that's the pizza side.
Beer.
I mean, come on, they put them both together. There are International Beer Days and National Beer Days and National Pizza Days, but this is International Beer and Pizza Day. My guests today were Todd Rosenbluth, head of research at Vetify. Go to vetify.com for more details. Dan Dorval, partner at Dorval and Chorney. The book, Financial Success for the Rest of Us, Quality of Life Planning for Mainstream America. That contest will be next week, where we have a couple of copies, autographed copies to give away. But if you want to learn more about him or the firm, dorvalchorney.com. And then Rob Spivey, Director of Research at Valens Research, valens-research.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Antti Ilmanen, who said, even rational predictions only work on average and can fail for a long time. Yeah, so you take predictions with a bit of a grain of salt, understanding how they work and don't work, and you remember, until we do this again the next time, predictions or not, the best thing you can do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Have a nice day.